I want you to sort of explain a little bit about after-tax yield, right? We know that the SMAs are not for everyone because obviously there are minimums like we were talking about, and not everyone has 250 grand just lying around, right? But also it's really targeted specifically on the muni space towards higher income earners, right? Folks that are in the 20, 25, 30, whatever the tax bracket is, or marginally at least, the higher it is, the higher your tax bracket, the more and more desirable these munis are because of something called after-tax yield. So if you don't mind sort of explaining a little bit about that concept.
Yeah. So speaking generally, interest received from municipal bonds is tax exempt on the federal level. It could even be potentially tax exempt on the state level as well for some states, including Massachusetts. If you're in Massachusetts and you buy a bond issued by a Massachusetts municipality, that would be the interest received would be exempt from not only federal but also state income tax. So what Matt was talking about with quote unquote after tax yield. Let's just take a basic example. Let's say you can buy a CD from a bank or a federal bond issued by the federal government, also known as treasury bonds. And let's say, just for the sake of simplicity, again, both of those, the CD and the treasury bond, at the moment you can get a 4% yield to maturity. So you buy those, you receive 4% interest roughly on whatever you put in. Now that interest is going to be taxable. So you're going to have to pay federal income tax on that. If somebody is in a 22% federal bracket, then in essence, they're only going to actually keep 78% of the interest that they received because it's going to be subject to 22% income tax if that's where their top dollars are getting taxed at. So for the sake of simplicity, just I don't have a calculator on me, but let's just say that the 22% tax, let's just call it 25% just for the sake of simplicity because that's 1/4. So in essence, you're losing a quarter of the interest that you receive to tax. So that would basically make the after-tax yield roughly around 3%. Because a quarter of 4% would be 1%. So effectively, after you pay tax, it really is more like 3%. Now, let's say that you can get maybe 3.5% or 3.75% or even 4% right now on similarly rated, or even maybe if you wanted to take a little bit more risk, maybe even higher on lower rated bonds. But let's just say for the sake of simplicity, similarly rated municipal bond, you can get, say again, 4%. That is not going to be taxed, at least on the federal level, potentially on the state level, but again, for the sake of simplicity, most of that 4% yield would truly be very close to 4% on an after-tax basis.